In this video, I'm going to give you 12 dividend stocks with 5 to 12% yields, and every single one is super undervalued right now, as many of the best investors say buy things when no one else wants them. You don't want to miss out on these, because some of them are the cheapest they've been in 25 years. Every one of these companies is financially strong enough to pay their dividends for the foreseeable future. Their stock prices are close to all-time lows, which means their dividend yields are at all-time highs, and institutional investors are buying and holding them, indicating they could be good long-term investments. Welcome to Investor Watch, where you get to watch me use data to come up with investment ideas. If you like it, hit the like button, and if you like free stuff, hit the subscribe button and get the list of 741 dividend stocks I used to make this video for free. Alright, let's get started. The first dividend stock is 3M. 3M is a multinational industrial company that has been in business since 1902. Well known for its research and development lab, it leverages science and technology across multiple product categories. They've invented a lot of things. One of them is Post-its, which I think is pretty cool. They're active in the following business segments: safety and industrial, transportation and electronics, healthcare, and consumer. Almost 50% of the company's revenue comes from outside the Americas, with the safety and industrial segment producing the majority of net sales. You can see on the weekly chart, its current price is where it was in 2013. It's been in a downtrend since January of 2018. That doesn't look very good like that, but let's take a closer look. There, I zoomed in to show just the current downtrend. Starting in 2018, I added a resistance line in blue and a price range calculator. Now if you look below the chart and see the purple area with a meandering line, that line is an RSI indicator. The lower the RSI indicator, the more oversold the stock is. When it's higher, it's overbought. This is showing the stock right now is really oversold. The last time it was this oversold, it bounced back to where I put the price range calculator. You can see last time it bounced back 65.5% and then continued its downtrend. So from where the price is today, it could bounce the same way up to that blue line and still be in its current downtrend. Let me add another price range showing what that same bounce would look like with a trade right now. There you go. This has the new price range if it took the same amount of time as the previous rally to get up to the blue line. It's showing a trade today has the potential to go up 57.9% and still be in its current trend. That looks enticing. Its market cap is $57.10 billion. Its PE ratio is 10.2, PS ratio of 1.71, and a PB ratio of 3.86. Its operating margin is 12.86, and net margin is 16.88. The biggest positive signs when looking at 3M stock include its PB ratio, PE ratio, and PS ratio are all close to 10-year lows. Also, its stock price is close to a 10-year low as well, while its dividend yield is close to a 10-year high. Its Altman Z-score, which measures financial strength, rates the company's financials as strong. But there are some negatives, and they include 3M's asset growth is faster than revenue growth. Their gross margin percent has been on the decline for a few years, and their operating margin has been declining as well. However, both gross margin and operating margin are still better than 78% of companies in its industry. Also, they are spinning off their healthcare division into a separate company by the end of 2023. That wasn't the strongest part of their business anyway. But it's unclear to me what value 3M shareholders will get for it. The hope is this focuses the management team on their core business. 3M also faces a lot of lawsuits and regulatory compliance problems. If they lose a big lawsuit, like their one with the military over their earplugs, it could cost billions of dollars. However, they did $34.29 billion in revenue in 2022, so maybe this is just the cost of doing business for them. On to the dividend yield of 5.78% and a dividend payout ratio of 59%. This payout ratio is higher than 85% of companies in its industry. However, they've brought it down since 2019 and 2020 when it was getting close to 80%. I think this is normal for a company that has paid its dividend for over 100 years. And increased it for 64 consecutive years. Dividend stock number 2 is Leggett & Platt Inc. This company designs and produces engineered components and products found in most homes and automobiles. It operates its business through 3 segments: bedding products, specialized products, and furniture, flooring, and textile products. Let's look at the chart. Last time it was this cheap was June 2020. It did go down an additional 30% from where it is now then. However, looking way back, the time before the pandemic, it was this cheap was all the way back in April 2014. That's kinda crazy. Its market cap is $4.17 billion. Its PE ratio is 13.81. It has a PS ratio of 0.83 and a PB ratio of 2.54. Its operating margin percent is 9.38, and it has a net margin percent of 6.02. It has an analyst consensus of hold. Positives include its PB ratio is close to a 10-year low, its PS ratio is close to a 2-year low, and the Altman Z-score rates this company's financials as strong. Its negatives are that asset growth is outpacing revenue growth. Also, gross margin percent has been declining and is worse than 76.68% of companies in its industry. You can see this is due to them taking on more debt in 2019. However, since then debt has not increased. In the company's 2022 report released in February of this year, they showed total sales for 2022 were up 1%. Earnings before interest was down 19%. Operating cash flow was up $170 million. Stock buybacks totaled 1.7 million shares at $35.94. The biggest warning to me is if they ever get in the position where they're issuing new shares to pay their large debts, then shareholders will suffer. Now to the dividend. It's yielding 5.6%, which is close to a 2-year high. However, it has a dividend payout ratio of 77%, just barely made the cut with that payout ratio. Dividend stock number 3 is Huntington Bancshares Inc. Huntington Bancshares is a regional bank holding company headquartered in Columbus, Ohio. The bank has a network of branches and ATMs across 8 Midwestern states. Founded in 1866, Huntington National Bank and its affiliates provide consumer, small business, commercial, treasury management, wealth management, brokerage, trust, and insurance services. Its market cap is $16.11 billion. Its PE ratio is 7.67. It has a PS ratio of 2.23 and a PB ratio of 1.03. Positives include the PB ratio and the PS ratio are both close to 2-year lows, while the PE ratio is near a 10-year low. The only glaring warning sign is that insiders have been selling the stock. It has a dividend yield of 5.58%, which is near a 2-year high, and the payout ratio is 43%, which makes this dividend looks pretty safe. This is a higher yield than 73% of banks. Dividend stock number 4 is Financial Institutions Inc. This company operates as a financial holding company, engages in the provision of a wide range of consumer and commercial banking services to individuals, municipalities, and businesses in Western and Central New York. You can see going back to 2023, this stock has had dramatic run-ups to 36 to 40. Then during times of crisis, it drops sharply to below $14. At the time of making this video, it's around 19. Definitely a historically good price, although there may be more downside to 17 or even 16. It has a market cap of $296.75 million, a PE ratio of 5.42. A PS ratio of 1.41 and a PB ratio of 0.76. All rank quite well compared to its industry. Positives include the PB ratio is currently near its 2-year low, while both the PE ratio and PS ratios are close to 10-year lows. Also, they have consistently grown revenue per share. Its dividend yield is 6.07%, which is close to a 2-year high. It's got a dividend stock number 5 is U.S. Bancorp. As a diversified financial services provider, U.S. Bancorp is one of the nation's largest regional banks, with branches in roughly 26 states, primarily in the Western and Midwestern United States. It has a market cap of $54.9 billion, a PE ratio of 9.64, a PS ratio of 2.2, a PB ratio of 1.25, a net margin percent of 24.09. The PB and PE ratios are close to 2-year lows. The PS ratio is close to a 10-year low, and revenue per share has been consistently growing. The only negative is that asset growth and debt to a certain extent has outpaced revenue growth. Also, Warren Buffett was once a major shareholder in this bank, but over the past few years has consistently been selling it. He's close to entirely exited from this position. Its dividend yield is 5.3%, which is close to a 10-year high, and the dividend payout ratio is 51%. Dividend stock number 6 is Ames National Corp., which is a United States-based bank holding company. Through its subsidiaries, it provides checking, savings, and time deposits, cash management services, merchant credit card processing, safe deposit boxes, wire transfers, direct deposit of payroll and social security checks, and automated/video teller machine access. Its loan portfolio comprises commercial, residential, and agricultural real estate loans, and business operating loans and lines of credit, equipment loans, vehicle loans, personal loans, and mortgage loans. Looking at its price action since 1998, you can tell it's below its historical average, sitting at $20.77. It could go down to $17 or $18, but unless there's more macroeconomic turmoil, this looks like a pretty decent price. It has a market cap of $186.23 million, a PE ratio of 9.68, a PS ratio of 2.98, a PB ratio of 1.25, and a net margin of 30.66%. Positives for this stock include insiders are buying it, the PB ratio is close to a 1-year low, and the PE ratio is close to a 2-year low. The one negative is that asset growth is faster than revenue growth, but its dividend yield is 5.21%, which is close to a 2-year high, and its payout ratio is a healthy 50%. The number 7 dividend stock is CTO Realty Growth, Incorporated. This is probably the riskiest stock in this video. Its financials are not super healthy like the others, but the stock has been beaten up so much recently. Along with having a solid core business structure, I included it in here. CTO Realty Growth Inc. is a Florida-based real estate investment trust company, which owns income properties comprised of approximately 2.7 million square feet in diversified markets in the United States. Its portfolio of assets consists of income properties, management services, commercial loan, and investments. Looking at the historical price, you can see it under $17. It's at a strong support level. Any further downside from here would likely mean it'll see $14 or even $13, but the upside potential, even within its recent range, is looking pretty good at about 30%. Its market cap is $392.61 million. It has a Shiller PE ratio of 6.81, a PS ratio of 4.01, and a PB ratio of 0.77. On the positive side is that insiders are buying it. The PB ratio is close to a 2-year low. The PS ratio is close to a 2-year low as well, and revenue per share has grown consistently. The negatives on CTO are they keep issuing new debt, and their gross margins have been declining. In fact, their Altman Z-score ranks them as in distress. Looking at their dividend, it's currently yielding 8.86% and close to a 10-year high, and its payout ratio is healthy at 55%. The number 8 dividend stock is Medical Properties Trust Incorporated. This is a healthcare facility REIT that operates one segment which owns and leases healthcare facilities. The vast majority of its revenue is generated in the United States, followed by Germany and the United Kingdom. You can see going back to 2006, this stock has lots of volatility and has gotten absolutely clobbered in 2022 and 2023. It's sitting at a support zone it hasn't been at since 2011. Any lower than the current price, and it will be as cheap as it was right after the banking crisis of 2008. Its market cap is $4.83 billion. The PE ratio is 5.42. The PS ratio is 3.15 and PB ratio is 0.57. Its gross margin percent is 97.04 and operating margin percent is 65.05. All of these rank quite well compared to its industry. The PB ratio, PE ratio, PS ratio, stock price, and dividend yield are all close to 10-year bests. The warning signs are that the company keeps issuing new debt, its operating margins have declined, and because of this, the Altman Z-score ranks it as in distress. But its dividend yield is 14.37% with a dividend payout ratio of 77%. Be careful with this one, especially in the current environment with rising interest rates. The number 9 stock is TROWE Price Group. TROWE Price provides asset management services for individual and institutional investors. It offers a broad range of no-load U.S. and international stock, hybrid, bond, and money market funds. At the end of February 2023, the firm had $1.314 trillion in managed assets. Approximately 2/3 of the company's managed assets are held in retirement-based accounts, which provides them with a somewhat more loyal client base than most of its peers. You can see from its price chart, getting in now and selling whenever the price gets back to its high point, which was 2021, would be a 96.08% gain. Its market cap is $25.72 billion, with a PE ratio of 16.79, a PS ratio of 4.04, and PB ratio of 2.85. Its gross margin percent is an impressive 54.96, and its operating margin percent is 38.47. Its positives include its financial strength is solid. Its Altman Z-score ranks it as strong. Its warning signs are the gross margin, operating margin, and net margin have all been trending down in the past few years. Revenue per share has declined. The dividend yield is 4.19%, which is close to a 10-year high. However, the payout ratio is currently 72%, which is higher than 58% of its industry and much higher than its historical median of 39%. The number 10 dividend stock is NDC Holdings Incorporated. This is an American holding company that operates home construction, mortgage, insurance, and title companies. The company focuses on single-family and residential communities via its Richmond American Homes brand in Arizona, California, Colorado, Florida, Virginia, Nevada, Utah, and Washington. This price action looks happier than the others as it's showing an uptrend. At $39, it's at a small resistance level. It looks like it's going to break through and continue up. Still, the safer entry would be to wait for a pullback to around $32 before entering. That would likely get you an entry at the second part of a double bottom formation. Its market cap is $2.83 billion, with a PE ratio of 5.02, a PS ratio of 0.49, and a PB ratio of 0.9. Its gross margin percent is 22.92, and it has an operating margin percent of 13.54. On the positive side, its operating margin percent has been increasing. Its revenue per share has consistently grown, and its Altman Z-score ranks its financials as strong. Its warning signs include that it keeps issuing long-term debt. Also, insiders have been selling it recently, and the stock price and PS ratios are close to one-year highs. Now to the dividend, which is yielding 5.18%, which is near a one-year low, with a payout ratio of 26%, which for the yield is pretty impressive. The number 11 dividend stock is Brookfield Infrastructure Partners LP, which is a Bermuda-exempted limited partnership that owns and operates quality infrastructure assets that have low maintenance capital costs and high barriers to entry. The company's segments consist of utilities, transport, midstream, and data. Taking a look at the price chart, it looks beaten up and in a downtrend, but at a strong support level around $15. Only once has it been much cheaper than it is now. It has a potential upside of 68%, which is not typical for a well-funded infrastructure company. Its market cap is $15.52 billion, with a PE ratio of 245.29, a PS ratio of 1.11, and a PB ratio of 2.43. Its gross margin percent is 27.17, and its operating margin percent is 24.17. On the positive side, this company's PB ratio is at a year low. The revenue per share has consistently grown, and its PS ratio is at a 10-year low. The negatives include long-term debt is increasing. Its gross margin percent and operating margin percent has been declining, and the Altman Z-score ranks this company in distress. The dividend is yielding 4.28%, which puts it at a 2-year high, and the payout ratio is 36%. This dividend yield is at a 2-year high. The number 12 dividend stock is Foot Locker. Foot Locker Inc. operates thousands of retail stores throughout the United States, Canada, Europe, Australia, and New Zealand. Their recent low is about $20, which is half of where it sits today. The resistance zones at the top are $65 and then $80, so it has a bit more upside potential, but not as much as the others in this video. Not yet anyway. It has a market cap of $3.75 billion. Its PE ratio is 11.15, a PS ratio of 0.43, and a PB ratio of 1.13. Its gross margin percent is 32.01, and its operating margin percent is 7.91. The positives include its operating margin percent has been expanding and its revenue per share has shown consistent growth. Its negatives include its asset growth is outpacing its revenue growth. Insiders are selling, and the Altman Z-score ranks it as gray, which is not good but not horrible. Its dividend yield is 3.98% with a payout ratio of 44%, which are both pretty solid. That was the 12 dividend stocks that are massively undervalued right now. But before you go, if you like free stuff, check out the links in the description. I've put a spreadsheet of the 741 dividend stocks institutional investors own that I researched to make this video, and it's all yours free as my way of saying thank you for watching. Make sure to hit the subscribe button to get more videos like this one. Once you become a subscriber, you'll get more free investing stuff like worksheets, ebooks, spreadsheets, calculations, stock picks, market summaries. Don't